Hello everybody, and today we will talk about how to read trading charts. No matter what assets you are trading, you need to know how to follow charts. The ability to read trading charts is the part and parcel of trading. And the more you understand about technical analysis, the better trader you can become. Like all things in life, the more you practice, the more you enhance your skills. Traders that use charts are known as technical traders. They prefer to follow the predictive powers of charting tools and indicators to identify picking trends and price points in order to guide them on when to enter and exit the market. On the other hand, fundamental traders prefer to follow news sources that offer information on economic growth, oil supply, employment data, interest rate changes, and geopolitical drivers like a war and political instability. When you hear a bullish trend, you are looking at an overall upwards trend, and the bearish trend is a sequence of decreasing lows and highs. There is a third kind of trend that is known as a sideways, float, or horizontal trend, which moves across. A ranging market is when the price of the asset hits the same heights, resistance lines, and lows, support line, at least 3 times in a succession. It is said to be trading in a range. There are 3 main types of technical analysis chart: candlestick bar and line chart. They are all created using the same price data but display the data in different ways. There are 3 main chart types that are popular among trading circles. Each chart type offers a variety of different information according to the trader's individual skill level. Line chart is the most basic of trading charts and the stepping stone for a beginner trader. This chart represents only a closing price over a period of time. The closing price is often considered the most important element in analysis data. This is in essence how the line chart is formed, by connecting the closing prices over a set of time frame. There is no visual information or trading range, meaning no highs and lows and nothing on opening prices. Bar chart, expanding in more detail on the line chart. The bar chart includes several more key fragments of information that are added to each data point on the graph, made up of a sequence of vertical lines where each line is a representation of trading information. They do represent the highs and low of the trading period as well as the open and closing price. The open and the close price are represented by horizontal shorter line. The open price is the dash that located on the left side of the vertical bar, and conversely the close price indicates by a similar horizontal line to the right side of the bar. Understanding this trading chart is simple. If the left dash, which is open price, is lower than a right dash, closing price, then the bar will be charted in green, black, or blue, and represent the price increase and the instrument gained in value. The opposite is true, and the decreased value of the stock is indicated in red. Candlestick chart. Once you have mastered the line and bar chart, you can move on the candlestick chart, which is similar to the bar chart. The vertical lines of the both charts illustrate the trading period's price ranges, while the body of the candle uses different colors to represent the market changes at that time period. Dating as far back as 17th century, the Japanese began using technical analysis to trade on rice. Hence, the Japanese candlestick commonly in use today. The data related from the candlestick include the height, lows, open, and close prices. The hollow and the colored portion are called the body. The long thin lines above the below the body represent the height or low ranges and are also referred to as either shadows, wicks, or tails. Should the lines be placed at the top of the body, this will tell you that the height and close price, while the line at the bottom of the graph indicate the low and the low's close price. The colors of candle body do vary from broker to broker. However, there are usually green, illustrating a price increase, or red, being decrease in price. A hollow candlestick is where the close price is higher than the open price, which will indicate to traders to buy. Filled colored candlestick where the close price is less than open will indicate the sell position. Low versus short bodies will indicate the buy or sell pressure among traders. Short bodies represent very little price movement and are often traded as a consolidation pattern known as Doji. Doji is an important facet on the candlestick bar chart as they provide information in a number of candlestick patterns. These from when the instruments open and close prices are virtually equal and there is not much more price difference. The relevance of doji candles are to show traders that after a long green candlestick, the buying pressure is starting to weaken, or after a solid red candle, that the selling pressure is starting to decrease and the supply and demand are starting to even out. There are a variety of patterns you can identify just by looking at the chart. The nature of chart patterns is based on the fact that human psychology doesn't easily change and therefore history tends to repeat itself. Chart patterns demonstrate the psychology of the financial markets and under the assumption that chart patterns worked in the past, so too will they work in the future. They give you closures as to the potential direction the trend will follow. They are at the heart of all important prices moves, and that from a connection between trends. You can use chart patterns as self-contained strategy for your trading. Some of the most important patterns to know include triangles, a continuation pattern which shows a battle taking place between a rising and falling price. This means the price is eventually expected to continue in the direction it was traveling before the pattern was identified. Another key pattern to know at the double top, which shows the price making two highs and indicates a reversal in the bullish trend to a bearish trend. In converse, the double bottom identifies the trend's reversal from bearish to bullish, meaning an impending uptrend. From these examples, you can understand just how important being able to identify patterns is to your trading outcome. As you grow more comfortable reading and examining the charts, you will then learn how to add other tools such as technical indicators to measure the rate of the market volatility and changes in value. These technical indicators will help you to learn when markets are oversold or overbought. When the market is oversold or overbought, it's struggling to maintain its direction and often suggests a reversal is imminent. You will use momentum indicators like oscillators, which measure a speed or velocity of the asset price. Examples of the most commonly used momentum indicators are RSI, stochastic, and the MACD. Other forms of analysis will help you to identify when to enter and exceed a trade, such as Bollinger Bands. 14 trend line indicators like a moving average simply help you to identify which way trends is moving by cutting out all of the noise of the smaller price movements. With these indicators, you can use a few in tandem to confirm your signal. They all feature on the most trading platforms. Visit our Just to Trade platform now and take a look. For today, that is all. Thank you so much for your attention. Wish you great trades. Stay safe. See you soon.